Regardless of whether you're a saver or investor, we all watched on in horror over the last year or so as inflation peaked to the highest levels we've seen in 40 years for both the UK and the US. Although there has been a significant drop, the overall headline inflation figures that we'll likely see this year still remain well above the 2% target rates of both the Bank of England and the Federal Reserve. High inflation, increasing interest rates, geopolitical tensions have all had a knock-on effect on the stock market and created a breeding ground for mass uncertainty and fear. But when there's a large amount of volatility in the stock markets, investors are faced with a bit of a dilemma. Do we wait it out until the market settles down, or should we be looking for a good safe haven to put our money? When it comes to such safe havens, there is one type of asset that investors have always returned to, and that's gold. In 2022, the demand for gold was the strongest it had been for a decade, and over the last few months, the price of gold has continued to teeter on the edge of the all-time high experienced in mid-2020 at the height of the pandemic. Gold has long been considered the ultimate store of wealth, and the price of gold often achieves its biggest gains during turbulent times as investors look to protect the purchasing power of their money. Not only that, gold investments are traditionally seen as a hedge against inflation because, unlike fiat currencies, it is limited in supply and cannot be impacted by interest rate decisions of central banks, nor can they print more gold to control demand and supply. This is why gold has historically been used as a store of value dating back thousands of years. But is gold really a good investment in modern times? And can it actually help us dodge the impact of stock market volatility in our investment portfolios? The problem is that gold has a bit of a mixed record when it comes to being a good inflation hedge. The common perception is that gold is an excellent hedge against inflation, because its price tends to rise when the cost of living increases. Over the past 50 years, investors have seen gold prices soar and the stock market plunge during high inflationary years. The relationship between gold prices and the stock markets has tended to be inverse. So when gold prices will drop, the stock market performs well, and when the stock market deflates, gold prices tend to track upwards as investors flock towards gold for safety. However, studies have shown that this hasn't always been the case, and that the correlation between annual inflation rates and gold prices is actually quite low. Yes, gold is more likely than not to do well when inflation is high, but it is not absolutely certain to do so. For example, in 1975, when inflation was almost 25% in the UK and above 9% in the US, the price of gold actually fell. It also fell in 1981 when inflation was 12% and fell again in 1989 and 1990 when inflation jumped from 6% to over 8%. In fact, gold has been a poor protection against inflation even over relatively long periods. In sterling terms, it was lower in 2005 than in 1980, even though the cost of living tripled in this period. At the other end of the spectrum, there have certainly been periods where the price of gold has increased, while consumer prices or inflation have risen. And it's these correlations in the data that lead the vast majority of us to believe that there is a connection between high inflation and a higher demand for gold. But it is difficult to say whether high inflation in these periods was directly responsible for the growing demand for gold, and there might be other factors that have a knock-on effect on its price. Recently, the yellow metal has made a bit of a comeback with steady growth of the gold price evident since the end of 2022. But this followed a relatively weak performance in 2021 and 2022. And there is some investor sentiment that gold's performance should have been a lot stronger during this period of high inflation across the globe. In actual fact, gold prices actually tracked sideways for the most part of this period, while inflation was at multi-decade highs. Although gold has been an inconsistent inflation hedge, there may still be benefits to holding a small amount in your portfolio if it fits with your investing goals. This is because it behaves differently to other assets like bonds, property and equity, so stocks and shares. Gold has historically had a low or even negative correlation to both stocks and bonds, which makes it a useful diversification tool. I've done a video on the benefits of diversifying your investment portfolio, so you can check that out after this one if you like. The goal shouldn't be to ditch stocks and shares at the first sign of trouble and put all your cash into gold. But we all know it's rarely wise to put all of your eggs in one basket, and that's why diversification is key. We saw that gold prices actually held up pretty well during the pandemic market sell-off in early 2020, whereby the S&P 500 contracted by 23%, but the price of gold stood relatively firm and dropped by less than 0.1%. Demand for gold from investors, central banks, jewelers, and tech companies is also on the up. According to the World Gold Council, global demand for gold was the strongest it's been for over a decade, with some analysts predicting upward steady growth over the next 5 years. If the rocky macroeconomic environment we've been used to over the last few years persists, and precious metals like gold still have much more room to run on price, then gold might well be a decent asset to hold through this period of instability. But gold isn't entirely risk-free and can actually be quite a volatile asset itself. As we saw in late 2020, during this period the price of gold fell by 20%. Also, unlike other investments, gold does not pay an income in the form of dividends or interest, so it isn't a great wealth builder. So this means that the opportunity cost of investing in gold could be quite high if you're an income investor. In fact, the legendary investor Warren Buffett is one of gold's biggest critics for this very reason. Ultimately, the opinions of a multi-billionaire investor don't really matter because personal finance is about doing what's right for you. If you're looking to get exposure to gold, then it's important that you do your own research and due diligence to see if it aligns with your investment goals. You can purchase gold bullion directly in the form of gold bars or coins. In fact, there are tax advantages of owning physical gold depending on how it's held, so that's definitely something to look into if you're keen on buying physical gold. Otherwise, you can hold gold as an ETF or exchange traded fund. For example, the iShares Physical Gold ETF is a good option to consider if you prefer the ETF route, as it backs your investment with physical gold bullion. So you still get exposure to gold without the worry of where to store it, nor is there any need for insurance, which both come at extra cost. Another way of bracing yourself for a potential gold rush is by buying gold mining stocks for companies like Goldfields Limited, whose prices have surged this year, outperforming the S&P 500 index. Gold has certainly proven over thousands of years that it's able to maintain its value over the long term, and because of this could definitely be considered an effective safe haven during times of uncertainty. Almost like an investment insurance policy for the defensive investors among us. This doesn't automatically make it a good investment though, especially if you're looking to build and grow wealth rather than protect wealth that you already have. So it really does come down to your own personal circumstances, your risk appetite, and what you hope to achieve by investing in gold in the first place. Let me know in the comments below if gold forms part of your investment portfolio at the moment, or if you'll be looking to add gold in the coming months maybe. As always, thanks for watching, and I will see you in the next video.